Bloomberg Audio Studios.
Podcasts, radio, news.
Let's go to one of our top ones coming out this morning. Heineken has taken a one-time impairment of more than 870 million euros for its stake in China's biggest brewer on concerns over consumer demand. Now, the world's second largest brewer also narrowing its forecast for its full year operating profit. Let's get a little bit more insight on some of these numbers and bring in the CEO of the company, Dolf Brink, joins us around the table. Well, I was going to say around the table, but next time you'll have to join us around the table, Dolf. This morning you join us down the line. Walk us through some of these numbers, especially when it comes to this impairment charge. What should our audience know about this?
Very good. Good morning, and thanks for having me from Amsterdam, indeed. Before talking to China, if you allow me very shortly, we are very pleased with our first half performance. Beer volumes up 2%, revenue up 6%, operating profit up 12.5%, so very good operating leverage there. Broad-based growth across our four regions, and the quality of the volume growth was very good and important, with beer volume up 2%. Premium volumes up 5% and the Heineken brand up 9%. So we had a very solid and positive first half of the year. Also, we are quite pleased with our China partnership. The impairment that we had to take, a non-cash impairment, is a technical adjustment that we have to do. Because as a minority participation, we need to value this on the share price, and the share price of CRB listed in Hong Kong dropped below the level that we acquired the company or the stake in back in 2019. We don't believe this is a fair reflection of the underlying operating performance. Since we took the stake in 2019, the net profit of CRB has gone up by 300%. Brand Heineken volume have gone up by 400%. Also, year to date this year, the Heineken volume in China is up 25%. So we're very pleased by the performance of the unit, but we had to take this non-cash impairment as a technical adjustment.
So Dolf, then walk us through that broader consumer story, because there's a lot of analysts, a lot of investors that are waking up this morning who are looking at these numbers and saying, well, how much of this is a broader China story, given that in other sectors across Europe and across the world, Chinese weakness is a broader theme. How much of that eats into your bottom line?
Yeah, we are actually very pleased to see that broad-based volume growth with modest pricing across the world. We still have high pricing in Africa due to devaluations and local inflation. If you take that out and look across APAC, across Europe, across the Americas, we see much more modest pricing than we have had in prior years, and that really allowed for volumes to bounce back. We are really looking for that kind of balanced growth of our revenue between volume and revenue per hectoliter. Key markets like Mexico, Brazil, very pleased with mid to high single-digit revenue growth. India, very important, high single-digit growth. Last year, we really challenged in Nigeria, where I'm proud of how our teams are navigating some of the local volatility, but volumes up high single-digit. So our key major markets outside of Europe performing well. In Europe, we saw volumes, beer volumes slightly up, pricing slightly up. Year-to-date May looked better, but we took a bit of a step back in June. We were expecting in June, July upside from the sports events, from the cycle of last year. That unfortunately didn't materialize. We believe mostly due to weather being much worse than we were hoping. You saw that particularly impact Northwestern Europe, East Central Europe doing better in that regard. But in the aggregate at the half-year mark, we're very pleased by that 2% volume, 6% revenue across our global footprint. We remain cautious. Indeed, consumer sentiment, particularly in developed markets like North America and Europe, are still a bit subdued, we would say.
Yeah, well, it's really fascinating that sports wasn't a catalyst for the business, but as you say, you're blaming the weather on that front in Northern Europe. What are current volumes looking like right now, Dolf, in the current quarter?
Yeah, we're always cautious to make those statements. We will update the market at the first or at the third quarter update end of October. What we did say in our release that some of that subdued volume in June was flowing out, over into July, and we believe mostly weather related. As I said, year to date May, our volume and revenue growth in Europe looked very promising. We're very happy to see that. We took a bit of a step back in June and now July. We still have good prospects for the remainder of the year. We believe indeed it's quite important that we keep the pricing modest to allow the category to regain its affordability. We're also making a major step up in our marketing and selling investments in the second half of the year, as we really intend to propel growth in the second half and the years to come.
Is that caution on pricing? Does that indicate you're seeing a little bit of softness? You're seeing a consumer that it is a little bit more conservative right now?
No, well, I think it has most to do with the recent past. Over the last 1-2 years, we and others, the industry, have had to take disproportionate amount of pricing due to incredible input cost inflation. That impacted our volumes last year. We had negative volume growth in our European markets last year. And that's why we're very happy to see volumes bouncing back, slightly up in the year to date, with pricing revenue per hectoliter still slightly up. That's a good place to be because it's really about stabilizing the category in that kind of market, and then still a lot of growth coming out of our global footprint.
So Dolf, let's zero in on that pricing conversation as well, specifically in the States, because one of the conversations we're hearing, at least on the consumer front out of the UK from the likes of Nestle, Unilever, et cetera, is that as the volumes drop, the pricing is what's making up the difference. I'm curious how much headroom you have that should your volumes drop, how much room can you actually raise prices, specifically when it comes to the American consumer?
Yeah, we are a relative smaller player in the US market. Our depletions to retail were down low single digits. We outperformed the market a little bit. So indeed, we still see a little bit of a subdued consumer in the American market. I think for us, control the controllables. We're deliberately keeping our pricing modest, but still in positive territory. And what's most important is invest in our brands, in our portfolio. Premium beer continues to do very well, up 5% at the half-year mark. Brand Heineken up 9.2%. Very important, and there's a lot of momentum there in 0.0 beer. We are by far the global market leader. We calculated that we captured around 50% of the growth of the segment over the last 5 years. With Heineken 0.0, we have the number one 0.0 beer brand on the planet, up 14%. So it's control the controllables. Invest in our brand portfolio, invest in premium beers, invest in 0.0, and that is what we will focus on going forward.
All right, so Dolf, let's then talk about one of your competitors if we can. Carlsberg is venturing in to the soft drink space. Is that something you would consider, broadening out beyond beer?
I cannot make statements, on future M&A. We are selling soft drinks in different parts of the world. We are proud to be, soft drink bottlers in part of our global footprint. When it makes sense in local markets, we will, proudly continue and contemplate that kind of diversification. But we remain first and foremost a beer company, a beer and cider company, and we believe there's still a lot of embedded growth to unlock. And again, that's giving us the confidence to plan for this material increase in our marketing and selling expenses in the second half of the year and going forward.
Well, we look forward to seeing how that all plays out. Heineken CEO Dolf van den Brink will have to leave the conversation there. We thank you so much for joining us.